So I want to start talking about Schedule F. This is farming, farmers, anything related to agriculture, and a lot of people who start doing farming and is actually starting from their sole proprietorship setting, and is all on Schedule F. So I want to focus on Schedule F today to really bring some key elements to your basic understanding. You're never going to be able to become a professional Schedule F filer like our folks here. But what we want you to know is what's critical, what's in our mind when you come around goes, hey, Ying, I want to file a Schedule F. I'm a farmer. And then we think of these things. So that's what I called, learning, right? Sharing, so we can be all on the same page. So let me go to lead you to our slide, which will guide us going through the content we want to go through. And it is actually a discipline for me, so I don't run out of tangent and telling you something that you are not expecting to learn. Not that is not useful, it is just not focused. So sometimes the people who really need to know that piece of information will never think, oh, Ying mentioned that under Schedule F for farms. But we want to concentrate everything related to farms here. And this is Valley Chicken Farm. And this is the farm inspired me to think that we need to talk about it, because these are, sometimes you started these kind of things with 10 chickens and 20 chickens. The next thing you know, you bought a chicken farm. So it's really, life is like that. We didn't know what we get into, and slowly we look back, goes, oh yeah, now I know why I'm accountant. Okay, I never really imagined community CPA will ever existed, but it is just by sheer fact, and it just becoming that way. So being a farmer sometimes is not your choice, right? It is you led by life, and you just kind of, oh, I'm a farmer. So now I need to know how to do farm tax return with Ying. So that's why you're here. And Happy Valley Chicken Farm, that is the inspiration. All right, speaker information. I have this book and published in 2019. It is really a book for starters. And if you just want to start, if you just started your business and you want to grow it, how to get it born, how to take it and start it. And that's everything about in this book. I call that 8 a.m. because that's, you wake up and you start things, right? And then I'm writing. The second book is 10 a.m. That is how you grow your business. So with 8 a.m., 10 a.m., and 10 a.m. will be out this year. And then I will do 2 p.m. and 6 p.m. So I have 4 books, talk about 4 business stages: starting, growing, expanding, retiring. And that is just how life is. That is how business is as well. So, go on Amazon, it's available there. We also have audio version of this book, so you can listen in. For more information, folks, we got a new website, so you got to visit that communitycpa.com. And of course, I just told you the YouTube channel, that is Community CPA. I just had a couple people today I met and help them to subscribe to our channel. So you know how to subscribe to it, right? Just go on to Community CPA YouTube channel, then just click that subscribe button. What that does for you is when we launch new, when we put in the new videos, and you'll get a notification. Of course, you can turn off the notification so it doesn't bother you with a ding, but you can come to look at it. But you can also know that, oh, something new got posted. We always posting things that most important for folks, because we hear your questions. We have over 10,000 clients. Trust us, we know what are the most important questions is out there. So we bring that on to this webinar. And you may say, well, why is Schedule F becoming important? Because there's a lot of understanding related to Schedule F. So we want to clear that And we have a lot of farmers who are also our client, and some of them are on Schedule F, some of them are on 1065. So with the majority of them on Schedule F though, and we think that it is important to bring that on so you know what to talk to your tax preparer when you are the person filing Schedule F. No responsibility disclaimer is it is a statement for what we're doing right now. So information we provide on internet, and really you need to take responsibility and don't just copy and paste on internet because maybe outdated, maybe it is wrong, and maybe you understood incorrectly. So there's so many reasons to be wrong, right? So just be responsible. If you really are making a serious decision and you want to consult professionals. All right. So story about Happy Valley. Stephanie has a full-time job and he has a farm called Happy Valley. He raises chickens and sell both chicken and the eggs to the customer. And originally the selling is just related to her family and a friend, and nobody really does, she's not doing that full time and she has a full-time job. But over the time, and especially over the COVID time, and her chicken has gained some popularities because she is such a, I think she just has a weird way to raise the chicken. She fed the chicken with wild berries as the main food consumption. So you might say, oh, really, Ying? And what's she gonna do in the winter? And I actually asked that question, what are you gonna do in the winter without wild berries? And she would say that she actually mixed the dried ones that she did in the summer and then mixed with other ingredients to feed the chicken. So her chicken lay berry flavored eggs. Do you believe that? But that is the marketing. That's the marketing, okay? So she's now selling them under Happy Valley brand name on internet, shipped across the country. So this is Happy Valley Farm. And with that, she files Schedule F. The Schedule F right here, I'm showing you what it looked like. And there's 3 parts to it. Part 1, part 2, part 3. This is part 3, okay? And the part 1 is pretty much about income. And you notice that if you look at this a little closer, you see the part 1, farm income, it says cash method. Then when you look at part 2, it says cash accrual method. So if you are cash, you do part 2. If you are accrual method on your expenses side of things, on your farm income and the expenses side of things, you do part 2, part 3. So with that said, and this is one thing that we get a lot of questions related to the farming. So the farmers are actually not sure they're on cash and cash on accrual. So let me just kind of explain to you the difference. So-called cash method is really more like your bank statement. So if it is deposited to your bank, it is your income. If it is not deposited into your bank and you have it in your pocket, sorry, it is not your income. And if it is expense came out of your bank as an expense goes out, that is your expense. But if it is expense that you wrote a check but these people didn't cash it, so it didn't land on your bank statement. And on December 31st, you notice that, Community CPA didn't cash out the check you wrote for the year. And those expenses under cash method, you cannot deduct because they did not go out of your bank. So just keep in mind, cash method is more like your bank statement. But when you talk accrual, it's different because when you know the income is coming, or you know that the income is in your pocket, you're supposed to deposit, but you just run too much errands and you forgot. And those are your income, folks, because they are surely already there. Expenses, the same thing. If you wrote a check for it and you already got the supplies coming in, you wrote a check, but you have a net 15 days or something. So the vendor who supplied you with the supplies and didn't really cash the check yet, you can deduct that check. even though they did not cash. So this is where the, these basic knowledge on farming would come in. So what we will tell you is that if you run cash method accounting and you use part 1 and the part 2, but if you do accrual method accounting, you use part 1 and part 3. So that gives you a clear understanding of what you need to do related to accounting method, right? Then you probably ask me that, Ying, what are the, I don't know which method I want to be. And can you tell me the pros and the cons? I'll tell you that majority of the farmers that we work with on our book, they are cash method, just because it is easy. It is easy because it matches to the bank. So we don't have farmers like making millions on their crops, and we just don't have those big farmers. But the medium small farmers, they don't really have a huge amount of income. And so really to do accrual and a cash doesn't really make a lot of difference for them. Now, let's look at what kind of business. Happy Valley Chicken Farm, that is of course file Schedule F, but what other kind of farming business you could have? So we kind of listed some of those, some of the popular ones you see. And folks knows that I only showed you the Schedule F. That's a farming activity done under sole proprietorship, which means that the farmer did not incorporate, did not set up a LLC, and he is just himself and, farming under sole proprietor. But can he set up a single member LLC? The answer is yes. You can set up a single member LLC, but you would still file that under Schedule F. And the under Schedule F, it also asks you about the NAICS code. So these are the codes, the numbers that you need to put in on your tax return. And I just want folks to understand why it is important, why these codes even make any sense to you. So know that an IRS has a data analysis tool. Okay, so when you choose yourself to be a vegetable melon farming, business, sole proprietor, understand that, and you won't have much of inventory. You don't have much of livestock, and you pretty much seeding it and farming it, forest come and you're harvesting it and you're done. So you have the seasonal waves in your income and expenses. So in your Schedule F, and if we break that activity by month, and you have the winter time is not a lot of activities, but in the summertime, maybe higher salary, higher wages that you pay to your helpers. So things like that would happen. So those code would help IRS to identify the weird duck. So if you say that I'm vegetable melon farming, then here you got these livestock and you're purchasing and you're trying to depreciate them and you're trying to make a claim on them. So these things are not fitting with your NAICS code. So we want to point out to you that NAICS code is literally important in tax return, and don't look down at it. Don't think it is not matter. It matters a lot. Maybe you get audited more because your NAICS code is wrong and your tax return looks so weird. IRS has to come over to see what you're doing, right? So that is that. And for income, so now let's talk about income. So under Schedule F, there's a couple of items we want you to know. A lot of time when you receive income for your Schedule F farming activity, and if you participate in co-op, and if you receive this conservation CRP kind of rent payment, those are government payment, and you normally, or government or a co-op kind of organized nonprofit payment, those are normally coming in with 1099. So I give you a item there. Cooperative distribution is like the dividend distribution, and those are counted as an income, folks. That's 1099 patronage, PATR. So you would receive something like that. 1099G, that G really stands for government. You get 1099G from the state, you get 1099G from the federal government. It's the federal government payment. And typically they do that because they want to preserve the land that you have. The government actually paying you rent income to keep the pasture going and to keep certain purpose for the land you own. And the commodity credit corporation loans is not always in want to look at how you did the loan. If you pledge part or all of your productions to secure that commodity credit corporation loans, the CCC loan, and you can elect to report the loan proceeds as income in the year that you receive. That's the easiest way to handle it. So a lot of times we see that income, we just simply claim that as income, but it is not always. And you don't have to. And if you did not pledge your, you did not do collaterals on your production, right? The crop insurance proceeds and the federal crop disaster payment, those are kind of like I wouldn't say accidental payment, but they're payment that with a program, right? If you had a drought in a year and you would get the crop insurance proceeds, and if you got FEMA declared disaster going on in your area, and the federal crop disaster payment would come in, and those for the cash basis farmers, those are taxable to what you received on that year you received. Okay, and for insurance proceeds, say you so you got the insurance payment and also the federal disaster payment for disaster damage to the crop. An election is available to defer that income to the next year. So so that you could, if you're a cash basis, that's what you should do. You just report that as your income, but you can also file election to defer that. So those are the key items on the income. Of course, if you have Happy Valley Chicken and Farm, they sell eggs, they have income. They sell their chickens, they have income. So those are just regular income from sales. But income from these areas, then you want to understand how to account them properly, right? And then, of course, expenses. There are anything. The definition about what you can do to what you can include to your farm deduction, and the IRS golden words are two: necessary and reasonable. So that's what IRS said. As long as it is necessary to your farming activities, as long as it's reasonable to your farming activities, and you can deduct. So we listed some of those expenses that is most often seen in the tax return. So I would say that if you start listing things like entertainment, meal and entertainment, I mean, everybody eats, right? But for farming industry, I will tell you that there's very few clients would have any deduction related to meal and entertainment. Farmers are known to be so hardworking. Who does entertainment? They work 24 hours and even in their sleep, and especially in the in the season, right? Then of course I come back to chicken coop, and the chicken coop that Stephanie has for Happy Valley Chicken, Happy Valley Farm. And then we want to mention about depreciation. In the farming industry, if you build a barn, right, or you build a chicken coop, and you have these, depreciation that you can do, Section 179, and a lot of, I would say that very rare, I see farmers use Section 179 because that one you can deduct it, but you are required to make money. If you make money in the farming, then you can deduct it. If you didn't, that Section 79 is not going to create a loss for you. But bonus depreciation is different, and it can create a loss for you. And the 2022 was 100% depreciation, but 2023, we're in 2023, and we're doing 2022 tax return right now. So if you build a chicken coop in 2022, and be sure that your tax accountant would account all of that for you as a bonus depreciation. But if that is not the case, you build in 2023, then only 80% that can be. The rest will be regularly depreciated by the IRS schedule. So we want to mention about deduction asset and all these investment kind of expense, and you have these two major tax tools to reduce your income. One important thing, and we come across all the time, is NOL. NOL stands for net operating loss. So what that do is on your Schedule F, if your income and the expenses, you take your income, you deduct your expenses, and you got loss, that's your net operating loss, right? When you have a net operating loss, it is different. It is different after 2021. So 2021 and then later, the NOL rule changed. So I want to bring this up because I often hear people asking me, can I do that? No, it is changed. And 2021 is not the same anymore. 2021, 2022, 2023, and forever so far, right? And it is this way. You can only deduct NOL, net operating loss, for the current year and any number of future years. See, any number of future years means until you finish. So it's not like limited you for 5 years, 20 years, no, any number of future years. So you may not carry them back to deduct in prior years and get a refund. So no, you cannot use the loss, go back to last year, reduce your taxes. You may not. NOL only offset up to 80% of taxable. So let's say you have an NOL of 100,000 and you can only offset the 80% of that year's net profit. So taxable income, that's what I mean. So let's say you have a NOL 100,000. You also have taxable income of 100,000, and simple, that should offset each other, be zero, right? No, you can only take down 80,000. So you still have 20,000 you need to treat that as taxable income. So it's 80% of taxable income for any year. That means whatever you do to the future, not 100%. And of course, it's not the same than before. So that's why we talk about this, right? So there's also an annual limit. So I just want you to kind of see the number, 262,000 if it is single. And then normally most of my farmers client, and they file married file jointly. So that's 524,000. So what that means is this, if you want to make the 524,000 completely offset and buy the NOL, the answer is no way. Only 80% of that can be offset. So let's see the example for myself. So Ying incurred 20,000 NOL in 2022. Ying will not carry to reduce taxes for any past years. Ying can only apply the NOL to 2023 or later, and offsetting up to 80% of my taxable income for that year. Makes sense, right? So you can go back. You can only do it this year and going forward. All right, let's just quickly refresh your memory of any years before 2021. So this NOL has a different rules between 2018 and 2020. So 2021 is what I just showed you right here, right? 2021 is what I just showed you, but 2018 to 2020 is different. It's different in such a big way. First of all, you can offset 100% taxable income, and you can also go back 5 years. So if I have a loss in 2020, and I can go back to 2015 to reduce my taxable income in 2015 and get the refund for 2015 tax refund. So that is, this is a NOL people were asking. Oh, you know, Ying, can we go back? Can we get, in 2021, we have quite a few questions like that coming from clients not knowing the rule had changed, but know that it's changed, folks. NOL is not the same anymore. And we don't have the good olden days from 2018 to 2020. And those are the days, yes, if you have a NOL loss in those years, yeah, you can go back 5 years to get the money back. The other things we want to remind folks is the standard mileage deduction. And in farming world, farmers, and you may have tractors where you use as a machine. So they're not, they don't need to be under mileage kind of calculation. But you could have a personal vehicle where you're delivering things over to the supermarket, and you know your own personal truck is a personal truck, but you use for business. If that is the case, you can do business mileage, right? This 2022 year, it's just a lot of trouble because they split the rate. From January to June is one rate, folks, 58.5. Then from July to December 31st, and they raised it. So when you do your mileage calculation, so you need to prepare 2 sheets, right? From January to the end of June, then from July 1st to December. So let's just make sure that you are so aware of that difference. And when you present your calculation to your tax accountant, you're like, I know, I already calculated with different rate. They'll be so proud of you. So that is something that I want to mention. All right, sell our farm. And we have situations where the farmers had their home, their farm in together. So when you sell the farm, and remember the home you live in, that is, you enjoy the exempted capital gain tax of tax-free on your home. So even though you see your home and your farm to be one, but when you sell your farm and sell your home, and you really need to consider to, you know, mathematically and know that what is the portion of capital gain that applies to your residence, and what is the capital gain that applies to your farming business, because those capital gain for farming business, you would pay capital gain tax, right? But the capital gain that related to your personal residence, that one, if you are a married couple, you have a $500,000 capital gain for free. So don't overlook that. And also a lot of farms are sold by installment. You don't have to claim capital gain in one shot and kill your cash flow. And you can do installment claiming capital gain slowly, but you can have your home capital gain exemption for free and take that benefit right away, right? So there is a wrinkle in there when farmers and thinking of selling their farm together with their property. And that happens a lot when, you know, farmers wanting to retire, and instead of having the place they live and the farm, they actually sell that and bought a condo in town. And those things happen. But when you sell your farm, don't forget your residence on the farm and should have exempted capital gain applied to it. Then, so we talked a lot of things already, right? We're talking about the forms, we're talking about the income and some of those special income, what kind of form you're expecting. And then we talk about deduction and the mileage. And we talk about earlier And we already mentioned about this NOL things related to farm, and because a lot of farm doesn't make money, so NOL is real. Then of course sell of the farm, and now we want to talk about self-employment tax for farmers. So just remember, the 15.3%, that is the self-employment tax. That is not a small number because it is higher than the lowest income tax rate. It's higher. So a lot of times the farmers didn't really pay a lot of income tax, but they pay a lot of self-employment tax. So you want to make sure that the self-employment tax, and it is impacted by your net profit, right? So if you are not if you are not actively participating in farming, let's say you actually rent your farm out, and to someone who does the farming, all you are getting is the rent, then you want to consider yourself is earning that rent as a passive income, so you don't qualify for self-employment tax. But if you are participating in farming and you are working, tax would actually apply to you. And in fact, it is not a bad idea to have self-employment tax paid over the years, because that is the calculation, that is the accumulation for your retirement benefit. You know, folks talk about Social Security benefit, and we heard people talking, oh, the government is going to go bankruptcy, Social Security number, I'm not going to even enjoy it. The only way for a US resident and a citizen, after you retired and you don't get Social Security, there is a one way you don't get Social Security benefit, is because you're dead. And if you are still living, you will get Social Security benefit, whether you are in US or you retired back in Vietnam. You know what I'm saying? So Social Security, it is a very safe retirement for our seniors. It's a government backing pension plan. So I want to make sure that we restore our confidence to, to the system. And I never really believed when there's a talk about, oh, Social Security going to go bankrupt and there wouldn't be any money for me. And there's so much calculation going behind. There's so much of change Social Security Administration could do, and the program will still be there. So right now, the highest monthly payment for Social Security recipient is $4,700 with change. The lowest one is a $40-some with change. So majority of the American, and we are in the middle. So you are probably 2,000, 3,000 a month. So having said that, knowing the Social Security literally can supply you every month that amount, and no matter rain or shine, you get it. It doesn't matter which part of the globe you're gonna stay, and you get it. So that's the Social Security, that is the Medicare, that is the self-employment tax component, that is the 15.3%. So, and you, of course, if you know to deduct all these expenses, then your net profit is low. When your net profit is small and you pay smaller self-employment tax because you didn't really earn much, right? And the CRP, this is one of those payments will come in as 1099-G. And these payments are annual rent income. They are taxable and subject to self-employment tax as well, unless the farmer is claiming Social Security benefit already or on disability. Okay, so CRP different. If you're not on Social Security benefit already, and if you're not disabled and you receive CRP, that payment is subject to self-employment tax. All right, so let's talk about Schedule F filing due date. You're probably gonna go like, Ying, it is 10:40. So what do you mean by filing due date? Due date is April 15th. Of course you are right? Of course. But Schedule F has something a little bit special. So I want to bring to your attention, just for farmers, just for people who file Schedule F, or they are filing 1065 as a farmer, right? Just for those people. To avoid making any estimated tax payments by filing the return, paying the dues before March 1st. What I mean is, because you're a farmer, forget about making estimated tax payment. Just file your tax return before March 1st. Pay all the dues before March 1st. Then you don't have a penalty because you are the special farmer. Farmers is special, okay? So this is where a lot of our clients, elderly, and with technology being the way it is, and just mailing coupons is something really tedious. And as a CPA firm, we want to file everybody. We want to pay everything online. We don't want you to write a check, give to us, and we mail it out. It just never worked. So the elderly or people who retired, it's just hard to make these estimated tax payment. So what we want our client to do is that we don't do that, and that's okay. And you just come in by the middle of February. So we make sure that we file your tax return, pay all the dues on and before March 1st, then you're good. So this rule generally apply for farming and fishing income that at least 2/3 of the taxpayer's gross income is so. So basically what that means is that, let's say you make a W-2 income, and you make W-2 income, and your W-2 income is 50,000, but your farming income is 100,000. So it's 2/3 of your total income, right? Then that applies to you. So you can do that March 1st and then not bother with estimate. But of course, if farming income is only a peanuts in your whole 1040, then you probably fall back to what normally the rule is, which you need to pay estimated tax. If you owe taxes last year, you don't pay estimated tax, you're going to be paying penalty and interest. Okay. Those who choose not to file by March 1st should have made an estimated tax payment by January the 15th to avoid the estimated tax penalty. All right, so this is a conclusion of our today's Schedule F, folks, and we touched on the key things a lot of our taxpayers would have a reason to be unclear. They're not sure about the due date. Why is someone telling me it's due on March 1st? I don't get it. Now you know why, right? And why it is my NOL doesn't go to the back. Why do I have to wait for next year? Now you know why, because the rule changed, right? And why is my mileage calculation is not the same? Now you know why it's changed. So with all of these information we give you, we hope that to make you sort of like, oh yes, I think I know what you're talking about. And next time I see you, I can give you a more organized data. We love our client who comes in with organized tax document, or uploading their tax document with proper headings and just beautifully uploaded. We love our clients doing that. We even have a client sending in the tax document with gift wrapping papers and with a little bowl and a thank you note. Oh my goodness, when I saw it, I thought it was a real gift. When I opened it up, man, there's a whole bunch of tax document. So, but that's how things can be done to be so pleasant. So I hope that you had a good time with me today and learned a little bit things about Schedule F. And we will continue doing our talk with you every Saturday, 3 p.m. You will see me, or we don't leave. We stay on here, wait for you. And I will talk to you again. One last slide here is our website and Catherine at communitycpa.com email for your questions. If you have questions you want us to talk about, and you email us. Also, and I don't know what you know about our operating hours, and tax season is coming up. We for sure open 6 days a week, but in fact, we are the only CPA firm operating 6 days a week, whole year long. So we are 6 days a week, and you can call us Monday to Friday and 8:30 to 5:30 Central Standard Time. And if you are coming from California area, just kind of adjusting to our time. So that will be 10:30 to 7:30 your time. We are open, and we will be talking to you soon. Again and again. Bye-bye.